but thank you. It's great to be here. As Allison mentioned, I'm a very proud Tepper grad and have been involved with the business school for many years. One of our, what we call students in residence is here in the room. Thanks for joining us, Sarush. We have 3 right now. We're actually recruiting for an additional couple of interns that are starting as first-year master's degree students in whatever program it might be across the CMU campus. So welcome you to present yourselves and for consideration for that as well. So I'm going to talk today about 2 topics. So they're really different but integrated topics in a sense. One is about the incredible rise of generative AI and what's happening in the marketplace as a result of that. And the second is about what's happening right now today in the world of venture capital. If you're an entrepreneur or an investor, you care about both of those topics. And interestingly enough, my partner Jennifer and I have a great deal of prior operating experience before becoming investors. And we are seeing so many of our peers who started companies 6, 8, 10, even 20 years ago, raising their hands back up and saying, with what's happening in AI today, I can't stand on the sidelines. And we're seeing many new companies being started by, frankly, very experienced entrepreneurs, as well as those from really new and younger founders who are, basically propelling this market forward at a pace that's historically unheard of. The pace of adoption is really, really quite interesting. So let me tell you just for a second about Illuminate Ventures. Who are we? Illuminate is a seed stage fund. That means we're typically the first institutional round of investment in a company. Sometimes there's a pre-seed round. We're a little bit past that. In addition, we have a very specific focus in what the industry would call the B2B, business to business, or enterprise software category. That's all we invest in. We invest all across North America, but we're typically looking at opportunities with a little bit different lens than your other typical seed stage investors. We seek what we call further along companies. They may have bootstrapped to a first product. They may have spun out from a large corporation. They may have taken SBIR grants because they're deep tech and they can get government grants that are non-dilutive, which is really fabulous for founders to be able to leverage that. There's a variety of different ways they do it, but they are typically, quote unquote, further along. And the second really big and important criteria for us, because we're investing in the B2B space, is that they know how to express to a customer what their ROI story is. What is it that can show top line revenue improvement or bottom line savings? One or the other. It's pretty simple. But to be able to show that in a demonstrable way in a relatively short amount of time means that a company can effectively create their own tailwinds. And even in a really difficult downturn economic market as we are today, where many large corporations in small as well are having to reduce their budgets, cut the spend, not look at new opportunities, they will if they can demonstrate and monetize, if you will, the ROI of a product. So if you're thinking of launching a B2B company, whatever stage, whatever the market focus, that's something I would keep in mind. It's perhaps one of the most important and compelling attributes of a startup and their ability to get that initial traction in the market. The other thing that we've done, I think that's a little bit unique as a firm, is we've built something we talk about as our platform. And that platform is made up of our Business Advisory Council, our students in residence, and all of the rest of the network that my partner, Jennifer Savage, and I have developed over our many years as operators. But that advisory council consists of about 45 people. They sit on over 100 public company boards. They've sat on more than 250 private company boards. And all of that group, as well as our internship program, are intentionally diverse. So what does that lead to? It leads to a much more diverse inflow of deal flow. And our results as a firm show, that it's pretty straightforward. If you see more diversity, if you evaluate more diverse teams, you'll end up investing in them. And our results certainly show that. So let's talk about AI. There's no doubt this is a mega trend. This is something that's transformational in every aspect of our lives, not just the B2B world where we focus, but every aspect of our lives. You'll see some quotes here from some very famous people. Each of them is really meant to demonstrate the depth of their belief, and the rest of the world's really, in terms of the potential impact of AI in the world. It can do good things, but it also has the opportunity to create a lot of risk, and also to potentially, if not managed and regulated and dealt with it in appropriate ways, to create not just risk, but to have some negative impacts as well. We've all heard about bias in AI models. We have companies in our portfolio that are designed explicitly to help eliminate that bias, because once you build it in, even if it's completely unintentional, it goes forward and can have a very dramatic and unexpected impact. I'll give you one example, because I think examples are more important than just speaking words. We have a company in our portfolio, it's called Tazi, that actually has the ability to help business users use the models, the AI models, not just people with deep tech backgrounds. And through that, they have visibility into what elements are actually most influencing the model. As part of that, they were using a product, a model that they had built internally, to try to determine how they were going to go about determining fraud in the insurance industry in terms of claims for automotive, all sorts of automotive claims. And as they used this product, they came to understand that the model was using your zip code as one of the elements in determining fraud. And so guess what? If the model is learning on itself and you happen to be in downtown Detroit, or you happen to be in East Palo Alto instead of West Palo Alto, or other zip codes, this system was designing and self-reinforcing itself to assume that you were more likely to make a claim that could be fraud. Okay. So that's a problem. And that's not something that AI, without the proper governance, is going to self-monitor to address. And so there are all sorts of really interesting elements to this. You see the other specific here about Bing's chatbot not raising some ethical eyebrows, and also the impact that it had in a single day when some product doesn't work, and it has a direct impact on a public company's market value. Those types of things are issues that no one has had to face before, and suddenly we all have to address. So it's a very interesting world. It's a world of opportunity, but it's also a world with some risk that needs to be addressed. So AI is a big landscape. You can see here some of the elements of it, and those logos that you see around that wing are examples of some of the companies in our portfolio. You see Tazi down at the bottom. That was the one I was just talking about. But many of our companies that we've been investing in some of these cases for 5 and 7 years, have been leveraging AI. So it's not entirely new as of this spring that suddenly AI exists. There have been really many, many changes, though, in the market that have caused it to be able to accelerate. And that's what I'm going to talk a little bit about. So I'm going to focus on generative AI as we talk about this, because that's where the current acceleration is taking place. It is possible because of an entirely new class of models. And many of you probably are pretty familiar with this. But it's really now possible for machines to actually write code, to draw for you, to do this across every one of the dimensions that you see here, from images to speech to 3D, and to do it in an integrated way. That was not possible even 18 months ago. Not in a way that could be cost effective, not in the way that an individual business user could leverage it. I don't know about you, but I use these products every day now. I recently had a personal reason to use it. I needed to file a claim with the city I live in for a tree that had fallen on my house. Yes. What do I know about writing a claim to the city? Nothing, but ChatGPT does. And so I literally put the bullet points in, asked it to write a great story for me, and boom, literally 30 seconds later, including, by the way, I told him what city I was in. It came back with the name of the city attorney, the address of the city, I mean, things that would have taken me hours to diligence myself. Now, is it perfect? Of course it's not. And of course I had to go in and make some modifications, but every one of us is going to continue to see these types of solutions impacting our lives. So the fundamental question is, why wasn't it possible 18 months ago? Why is it today? And why do we have such aspirations for Gen AI going forward? I think it's pretty fundamental what the elements, the building blocks are, if you will. The models themselves are better. The training data, the amount of information that can be embedded, much more significant. The actual compute costs have gone down significantly. And it's the combination of those things, the model, the data, and the compute, that makes it possible. You need all three. Because if you look at large language models, they are very costly, even still today, to build. But the ability for others to leverage those and then build applications on top of that, it's pretty exciting. It started out with these small models. Again, as I mentioned, as long as 7, 8 years ago. It accelerated then in a race to scale that you can see on this chart. It's pretty interesting how, however, time has compressed. Look at the time frame that it took to get to the same level as how a human would perform that same task when you were starting back, pre-2000 versus where we are today. You can build one of these models and use it to do repeatable tasks that would be significantly more costly and time consuming for a human, and you can build them in very short amounts of time today. 5 years ago, it took years to get to the same level of capability. Now, what we're looking at is sort of a role reversal, if you will. The AI does the first pass, a human then reviews, right? And there are still cases where that's important. We're talking with a company right now that's in the legal tech area. What are they doing? The first pass on every contract they're scanning is being done completely using AI. But because contract management is so critical, you can't have anything wrong when you're then providing it to people and saying, here's how you're going to manage all of your contracts going forward. What they have is a team of attorneys who then review the data. But the first pass being done by the AI is better than the first pass that could have been done by a human. And they've measured this at scale with thousands and thousands of contracts. But they still have this caution of saying, we're still going to sample. We're still going to look at the most complex contracts and have a review conducted by a human. So much less time, much faster. And in the end, literally in the 99th percentile in terms of accuracy. Super interesting. So how are these ML models that we had, been working with and will continue to work with different from foundational models? Has anyone here been working on building a foundational model? How about machine learning? Any experience there? Yeah, okay. So I think what you'll come to understand, and maybe you do already, is that the cost of building those foundational models, as I already mentioned, is extremely high. But the leverage, once you've built them, is extraordinary. When we look in a few minutes at what's going on in venture capital, what you're going to see is groups like OpenAI and Anthropic, they're raising hundreds of millions of dollars to do what they're doing and building these foundational models. And not all of us can do that, right? But the good news is there's also open source foundational models that are being created. And there's going to be an opportunity to apply machine learning, leveraging these foundational models and do some really extraordinary things, as well as with, the fee for service, if you think of it that way, foundational models being built by these very large organizations. I'm going to pause for a minute because I'm curious. How many of you are thinking that you want to be a founder at some point in your careers? Okay, good portion. How many of you believe that AI is going to transform the world we live in? That's everybody. Okay. And how many of you are looking at AI and thinking, I have to understand this because it's a part of my career going forward? Okay. I mean, I'm just quickly around the room, I'm going to ask, can you name one other technology that you felt was so transformative that you had to go out and learn about it because you were afraid of being left behind? Anybody? Anybody have one? Sure.
It's not a technology, maybe a industry, robotics.
Robotics. Okay, robotics. That's a great example. I have to learn about robotics because if I'm in manufacturing, if I'm in transportation, if I'm in so many different categories, if I don't know about robotics, I'm going to be left behind, right? What is robotics going to depend on in the future? AI. Okay. Another, Sarush?
I'll change my mind. Like a few years ago, this thing
AR, VR? Okay, AR, VR. If we go back to this slide, there's an example on here of a company called Enflux, and you see that in the computer vision category. What does it depend on? Yeah, I got a smile, AI. Okay, there was one other?
I'm a biomedical engineer. For me, the longest time, like image processing technologies are like MRI. And yeah, there are also these multimodal sensor technologies which are coming out into all of this. This also ultimately transforms.
Okay.
AI being
Okay.
used.
Yeah.
Yeah.
I'm sure there are technologies and other issues that we all face that depend on more than just AI. Okay. I go back and I'll give an example of in my own family, my father, who, was born long before computers existed, long before cell phones existed, long before a lot of things existed. The most fundamental change was the computer, and then the iPhone, and then the iPad. And here's a guy who started before color televisions, so many different things did not exist, right? And he felt compelled to adopt these things or be left behind. I think we're going to experience the same thing. A few years ago, I might have said, we're done. Everything that is going to that dramatically change our lives is already here. I don't think that's true. I think we're going to see some really, really rapid innovation. Okay. So back to AI, because it seems like all roads lead there. But fundamentally, if you take a look here, what you see is a much broader landscape than just the models themselves. And there's some additional layers, if you will. The platform layer, which is where we as an investor see the most opportunity, because those are going to be the companies that leverage those foundational models. And then the tooling layer, which is where, for example, another company in our portfolio called Continual is there to help companies leverage these models in a way that allows them to build on top of them and deliver co-pilots leveraging these technologies. That's the new term in the industry as well. You have your AI co-pilot with virtually every business application. No longer are you going to go in and create reports. No longer does that company have to build reports. You're going to simply be able to ask the product, please create a report that has these columns in these fields, and it will be done. No more creating that from the inception of building a product. Many other similar types of examples. And so this is a very interesting area. And we're starting to see some notable players there, but it's also these top two layers, if you will, are where we see the most investment opportunity and the most startup opportunity. Because again, because these infrastructure layers, I think both companies that raise large amounts of capital and existing players, the Microsofts, the Googles, et cetera, of this world are likely to have some competitive advantage there because of scale, Okay. So I'm not the only one that feels this way. You can see the just incredible increase in investment from the venture world into this category over the last year. When you look at this, if you did not see those two other colors on the chart, the yellow that's there for OpenAI and the orange tone that's there for Anthropic, you might assume that the dollars going into Gen AI are just growing continuously and at an astronomical pace in number. But if you take those two out, what you actually see is that in the most recent quarter, the investment in Gen AI dropped pretty substantially from the prior quarter. Why is that? So interestingly enough, I think the realization is it's going to take time. It's not going to, this transformation isn't going to happen overnight. There is huge opportunity, but for a lot of companies, in terms of the buying community, it's still an experiment. It's still not fully embedded. Sure, question.
Back on your point on the last slide where you made that statement about how like incumbents have like a scale advantage. Can you talk a little more about like where you see like smaller startups having an advantage versus like incumbents or like if Eventbrite looks would they be able to have a generative AI event type thing or Microsoft or
Yeah, the question is really about where's the advantage, the opportunity for startups in this category. I think it's really simple. Where you have domain knowledge that you can apply and leverage these foundational models and build additional capability on top of that, there is distinctive opportunity. There is really unique opportunity for a startup. And so someone who has, a deep knowledge of, it could be anything, sales activity, like how do I select the best companies to sell to, and all of the attributes that you're going to use AI to evaluate in your own customer data sets and that kind of thing. Or if you are targeting a vertical like the insurance industry, a domain expert there may have very distinctive advantage to take their domain knowledge and leverage that against the data set that's now available in these large models. So I think that's a very clear area. There's also some areas in the tooling area, I would say, around governance, around risk management, around building tools that business users can use, not just technologists, where there's a significant opportunity as well. Any other questions right now? Yeah, I really encourage. So let's take questions as we go. So what's the market size look like? You can see it's enormous in terms of the overall opportunity, but you also see the date there. It's 2032. We're starting from very small numbers and we're growing really rapidly. It's a significant market increase in size. But if you take a look and say how much of that is software and how much of it is services and other types of capabilities, there's actually a lot of growth that's likely to happen with hardware, with chips, with all sorts of other technologies that are needed to support the infrastructure, if you will, behind these AI-based applications. Make sense? And what are the drivers of growth? This kind of comes down to exactly what you were asking about a minute ago. There's a huge amount of spend, but it really depends on the use cases. How are people going to use these products? And the only way that you can drive that is by driving specific understanding of how it will benefit the users. It can be consumer usage as well. It can be as simple as, yesterday, as I was searching for a product, I said, yeah, I'll try that new Google search capability. Why not? And see what difference I get in the results that pop up. But there are a variety of different B2B sectors, which is where we invest, that are the most likely to be impacted. That includes anything that is customer facing in particular. So sales, customer support, anything to do with engineering and R&D as well. We talked a minute ago about the ability to generate code in a way that never could be done historically. And I've seen the GitHub doing this new code pilot generation capability that's rather astounding. Not only can they create code from scratch, but they have the ability to analyze code and recommend improvements to it. They also have the ability today, they haven't released it yet, to take old code and bring it into the modern era. They can take COBOL and transform that into current code. Now imagine how many services business are going to go out of business because that's a service that they provide today, right? So it's very interesting to think about what the potential impacts are of where these products go. Question.
So while looking at investing in the first bucket, which is these tools that we spoke about, customer operations marketing, do you also look at how these tools can stand given the economic conditions. For example, customer operations is the bread and butter. We can't really do without. So like an end customer down using both software. Whereas marketing and sales, it really fluctuates based on the macroeconomic conditions. So do you apply that lens while investing in something?
Yeah, so I'm not sure if everyone on the Zoom would have heard your question, but you're asking really why invest in the customer-facing activities of marketing and sales if the operational capabilities have to be there all the time, and particular marketing and sales can vary. They can, you know, in a good climate, you typically have a larger budget for marketing, et cetera. It really goes back to the fundamental that I was mentioning before. It's the ROI story. If you can show a company, especially in a declining market that we're in today, in a tighter budget market, that you can improve their top line revenue cost effectively, not just at any cost, but that you can show the very direct ROI of that, they'll spend lots of money on sales tools. They may not even have the budget to do it, but if you can show the ROI, they can get the budget to do it. But your ROI has to be rapid. If it's not within less than a year, you're correct, then the day-to-day operating kind of tools might be where people spend more. They're likely to spend money on infrastructure, if you want to think of it that way, because they have to. But it won't be incremental. They won't go out and find a new tool to buy. They'll look for ways to reduce the cost of their infrastructure if they do anything. Will they buy something new? And we're talking about here, where can an entrepreneur get their first sales? It's likely to be in those areas where you can show top line revenue opportunity or pretty significant bottom line savings. There are tools today, of course, to automate your process of selecting the best AWS combination for your demand load. And you can show pretty significant, or even which hyperscaler platform you should move to based on your demand load to do it in the most optimal way possible, both from a cost and scalability perspective. That might be where in a declining market, you might think people will spend money, but yes, true. But then they'll also spend it on that top line increase. Other questions? No? Okay.
Hey, Cindy, I have one question.
So
Can you hear
this
me?
is just a little bit more detail. Oh, was there another question?
Yeah, can you hear me?
Yes.
Thank you. Thank you for the presentation. Just one quick question. It ties back to the previous question before, but we want to provide value to a specific enterprise or business, right? In this case, we're trying to build an application for architects and engineers. If we don't really have, we know that we can save them time, but when we ask them, how much time do you spend doing this kind of application? They don't really know how to quantify it. What kind of advice would you give the entrepreneur of how to quantify the impact?
That's a great question. And it's a tough question because time savings in a down market where a company doesn't have budget is probably not going to be sufficient to make it their number one priority. But you have to be their number one priority right now. If not, you're likely to get, gee, that's interesting. Let's talk again in 6 months when I can relook at my budget. That wasn't planned for, something like that. So we build, most of our portfolio companies build what we call an ROI calculator. It's a spreadsheet. It's not fancy, but it allows them to work with their customer to actually define all of those things. How much time are people actually spending on these tasks? Are there other attributes of what we're doing that save not just time, but money? Are we reducing the number of mistakes that are made? Are those costly? Our company Enflux that we were talking about, that's a computer vision company, does human in the loop manufacturing using AR, VR, computer vision to help guide humans helping manufacture. You might think everything's robotics. Turns out that's not the case. 80% of all manufacturing requires humans in the loop still today and probably will for the next 20 years. So, but you can improve their performance with AI as well. And they're able to not just show the time savings, which there clearly is, they can show a time to market savings in the sense that they can train new employees much more quickly by using this technology. And who knew, but turnover in manufacturing environments is literally close to 100% a year. So you are retraining people constantly, continuously. And if you can show that someone can be up to speed within 10 days instead of 30, that's huge, huge savings for them. If you can show the defect rate dropped by 20% and the rework rate dropped by a certain percentage, you quantify that as well. So you have to look deeply. That's the real answer. You have to look really deeply at what can be quantified. Another question?
Just gonna add on to that, if the customer, if you're looking at a product or service, the product company that's service true, if you look at a service company, that might be the target market this startup wants to look at, because time equals money. If they have like a base price of $100 an hour, and now everything's X as a service or the value-based pricing, that's where it's gonna hit the bottom line.
Totally agree.
Maybe looking at service providers that use that kind of engineering.
Yeah, totally agree. Okay. So if everyone didn't hear on the call, it was the statement that if a service provider is your target audience, time is money. It's that simple. So it's a great example. Other question?
Just a question about other use cases outside of the ones that are presented here. Have you seen any traction with respect to biotech or maybe food sector?
Yes. So the question is biotech, is that an area of application? Absolutely. This was research being done by McKinsey in the B2B space, which is where we invest, which is of course why we're most interested in that research. But in healthcare, in biotech, in all of those areas, there is a huge opportunity for Gen AI and every aspect of AI, without a doubt. Okay, so this is back to my point about adoption timing, that so much of it has to do with these indirect costs. It is not just about the engineering talent and the setup costs. It's really about all of the rest of the compliance and legal. I was part of a session not too long ago that BCG was running that literally said that 80% of the costs is in those areas, not in the direct operating costs, and that people are building these models and implementing without really fully understanding what the total cost of ownership, if you will, is. And so the opportunity, again, for startups is to come in and say to large corporations or even mid-sized companies, you don't have to do this on your own. We're going to build a scalable platform that enables all of you to leverage this and not have to build all of this compliance and other infrastructure as well. It's definitely becoming a crowded landscape in terms of competition. You can see many of the larger players listed here, but there are many more startups in the category. And again, as I mentioned before, we think the tooling and what we call the platform layer are really the areas of most interesting opportunity for startups. So overall summary, I think we've said it all here. You know, these horizontal B2B platforms are going to be very, very interesting. We think there's a huge amount of opportunity there. Packaged solutions that leverage AI ML are also with a vertical focus. We think also lots of opportunity there. And then there's this whole flywheel concept of what is the go-to-market motion? How do we enable product design and model performance to leverage that into a world where it's taken for granted, if you will, that you can, if you can build it, you can then bring it to market in a way that's very efficient as well. Because it's not just build it, the go-to-market becomes equally, if not more important in this process, right? And obviously for us, we're looking at companies that can scale, and we're looking at those that have management teams that understand these all-in deployment costs and can build a business and operating model that makes sense over time to build companies into large, profitable operating businesses. Okay. I'm going to just show you one more example. This is actually going to be a quick video about a company in our portfolio called Empathic. Empathic is a generative AI platform. They have been since inception. They were out there with GPT-3. They started their process. Woman founder, CEO, doing some really interesting background research prior to this around how do you communicate more empathetically, and leveraging, she's a PhD research psychologist, had a set of tools that she allowed a broad audience to use, built a proprietary data set around that, and now leveraging that in this world. you can see what some of the impacts are. So this 90% reduction in FDA costs, and this is going through the through the approval process. Well, it turns out that if you are running a clinical trial, you have to have monitoring of all of the content and communication between the vendor, the supplier, and those people in the trial. It is legally required that you you monitor that data, that you identify any weaknesses in it in order to avoid having your data not qualify, right? And these trials cost millions, and in some cases, tens of millions of dollars to run. And having poor communication happening between the provider and the patients can literally disqualify the use. And so this company is now working with them in a really interesting way to automate that process entirely. They're not just, tapping in and monitoring selectively. Every communication is monitored proactively, and they can make modifications to their process in real time. And it just huge savings. This example is a little bit different. It's a quick video I'm going to run through.
What you're going to see today is an entirely new way to deliver feedback to a manager, a colleague, or an employee. With Empathic's Feedback Assistant, you can convey as much or as little detail as you want, and Empathic will rewrite that in a way that's respectful, is specific, and actionable for whoever you're writing feedback for. So let's say in this example, I want to tell my manager that I'm not getting enough coaching, the feedback they're giving isn't timely and it's vague, and I'm not sure how to get promoted at this company. So when I click next, Empathic is going to take your input and it's going to rewrite it in a conversational format that you can then give to your manager in your HR system of choice, or even in an email, with feedback that's now actionable and specific. Another example of how to use Empathic's Feedback Assistant is to convey one idea, like my manager doesn't support me very well, and then leverage some assistance in what you really want to convey. So if they're not supporting, you could say they're not great at empowering the team, they're not good at developing the team, and maybe you want to add something in addition, which is, I don't know how to get more time with my manager. So as you can see, with a single idea and some assistance from Empathic's feedback suggestions, it converted that into a concise paragraph that you can use to start a conversation with your manager.
Just a couple of examples. Again, I think it's always better to see something and understand how it can be used. They're doing the same type of communication, not just internally for companies, but with their customers. Imagine you now are embedding this within your chatbot, and the chatbot's trying to get you to apply for a loan, but you don't qualify. How do you communicate that? Empathetically, rather than just saying, you don't qualify, go away. You've now ruined that reputation of that bank or that lending institution with that potential borrower forever, right? So there are many different use cases for what they've built. It's an API first platform that can be used for a whole variety of different applications, but super interesting. Okay, I am going to switch topics, and I'm going to be really brief and go through this at a pretty high level. I'm not sure if this is going to have the same level of interest for you, but it will give you some visibility into the world of a venture capitalist. What are we facing today in the current market? I know you're aware that it's tough for founders to raise capital today. You have to be aware of that. I mean, it's in every newspaper article, every podcast that you can listen to. But it's an interesting world as an investor as well. So overall trends, despite the fact that there is a very large amount of capital, what people call overhang, meaning capital that was raised previously that hasn't yet been deployed, venture capital investing has continued a very steep decline that began about 1.5 years ago. Okay, and it isn't stopping. We're not at the bottom yet for certain categories. Later stage rounds, as you might guess, are the most impacted because they were the most inflated in 2021 in what we would think of as yet another bubble in this cyclical venture capital industry. So those Series C, Series D, growth stage rounds that, non-VCs came in and led, it might have been, one of the large investment banks or others that were leading rounds then, are now underwater. Lower valuation than they had at the time. Even the IPOs that we've seen this year, lower valuation than they achieved in 2021. So anyone who invested then, despite the fact now they have some liquidity because of an IPO, it's not worth as much as the original check they wrote at those late stage rounds. And that has a lot of impact, right? Because of all of this combination of things, higher interest rates and other things, the terms today are much more investor friendly. And I'll show you charts on all of these things. The exit volumes and values have declined, and that impacts every venture fund's ability to go out and raise capital, because if they're limited partner investors, foundations, endowments, family offices, etc., pension funds haven't received capital in the last 2 years, they're very reluctant to write checks because they have to find it from somewhere else in their pool of capital. They're not just recycling money that they're getting back from their prior venture investments. Tough. And so there's a lot of fear as well in amongst VCs. If the market hasn't bottomed out and I write a check at a given valuation that I set, what if I'm wrong? And what if it declines 30 days, 60 days, 90 days after I invest in that company? And so again, there's this hesitancy that's built into the market. The good news from our perspective is software still dominates. It's actually a growing sector. It's also a sector where, with this proven ROI in the B2B category, companies are able to raise new rounds of funding. We've had 6 up rounds of funding in our portfolio over the last 18 months. That's rather phenomenal, to be honest with you. Most of them at nice increases in valuation, some extraordinary, but it's because of this ROI story. It's in large part because of that. And seed stage is still the place to be. So I'm going to go through these pretty rapidly, but I'm just raise a hand, jump in if you're on the Zoom call, if you have any questions. But you can see where we are in terms of the overall pace. The good news is that the pace of decline actually slowed for the first time in Q3. Okay, slowed. That doesn't mean it went up, it slowed. And that should signal some type of bottoming out, if you will, and potential to increase. What's noticeable, though, is if you look back, and this is only through Q3 data, obviously there'll be some additional numbers, and that's where those estimates are that you see the little dots on the chart. And each of the charts shows where they forecast the numbers to be in Q4. But what you'll see is, despite the fact there's all this decline, what really went on is there was a bubble. It was crazy. Look what was going on in 2021, right? And look at the prior 10 years. We can't just assume once everything that goes up will not come down. It does. And if you went back to sort of the 2000 timeframe, we went all the way back then during the dot-com bubble, you would see the same thing, and then a bust. Okay, so this is a cyclical market. Let's put it that way. I think it's also noticeable that literally every stage of investment was impacted. Every stage, not just, the latest stage rounds. Now, the latest, obviously the most, but across every stage, there's been an impact. I mentioned software has gained share, and someone was asking earlier, what about in the healthcare space? What about pharma and biotech? You can see the numbers here. There's been a pretty significant share shrinkage there. If you look at pharma and biotech, it's this orange line. You see what share it was in prior years. It's actually declined more recently, offset by some other areas. But the biggest decline in there is actually, if I remember correctly, in transportation. Big decline over the last couple of years. And then, something that's troubling to us and to me personally is what's going on with funding for people of color, and in particular, Black and African-American founders. The numbers were abysmal to begin with, but they've continued to decline. And this is what people talk about as a flight to, what they know, to pattern recognition. What worked for me before? When times get tough, you tend to go back to what worked for you in the past. You don't experiment. And so I think that's one element in this. I don't think it's intentional bias 99.8% of the time. I think there is just a natural instinct when you're fearful, which investors are to some extent today, that you don't take these new initiatives, but it's distressing. Mixed gender has actually increased, which is great to see, but it's actually driven in large part by a few very large deals like OpenAI. When you look at the these multi-$100 million financings, they tend to sway these numbers. If you didn't, it would be back roughly to where it was. Now, this means there's at least just one single woman on the founding team. So getting this in the past to 20% meant that 80% of startups didn't have even one woman on the founding team. Kind of shocking, right? By the way, our numbers look a lot different. These are Illuminate's numbers in terms of BIPOC, female, and immigrant founders. We are extraordinarily diverse as an investing team and in terms of the founders in our portfolio. We're super proud of it. We don't use it as a mandate. We simply find ways to level the playing field, invite a broader audience, and then we pick the best companies that we see. So despite all of the negativity that I've heard, and like, now you're terrified, should I start a company? Oh my gosh. It's actually still, from our perspective, a great time to be seed stage investors. You can see how the multiples changed over the years, but in virtually every case, you are going to get a better multiple as an investor by investing at seed stage than if you start later in the process. And so we understand the risk that's involved, and there certainly is. Our loss ratio is right around 20 to 22%. The industry average, however, is closer to 40%. And so for a lot of funds, they have to really look at this carefully. And you can also understand why for a lot of investors, limited partner investors, the people who invest in the funds, there's some hesitation about, do we invest at seed stage or later? They feel like it's safer later, but in the end, it actually isn't. If you have the right portfolio construction, you're going to have better outcomes from investing at seed stage. And then you can see enterprise SaaS, which is, again, where we invest primarily, has not declined nearly as much as some of the other categories that we were sharing before. Again, that's the good news for us. And a lot of it is people need these products. AI is also elevating interest in businesses because they understand they'll be left behind if they don't start adopting these types of technologies that enable digital transformation. Exit values, and this plays to like, why isn't the capital being deployed, are significantly down, 90% from the peak in 2021. But again, look at how crazy high they were, and look at where the levels were before. We're creeping back up, as you can see in Q3, and probably back to a more normal future over the next couple of years. The public window cracked open slightly. If you've been watching this, you know that ARM and Klaviyo and Instacart have gone public, but their post-IPO performance, which is what people really care about, because anyone who was a prior investor is locked up for 6 months, it's still unproven. And they haven't just skyrocketed up the way that IPOs have in the past. So what's likely ahead for exits? Well, we still have the same pressures going on. We have the fear of a recession. We have high interest rates. They haven't started downward yet. There's a lack of confidence, I think, as to really understanding where things go. I didn't mention here, but what's going on in Israel, what's going on in Ukraine, what potentially is going on elsewhere in the world that people are fearful of, has a very direct impact as well. It doesn't hurt that if you put your money, or it doesn't help, I should say, if you put your money into any type of insured money market account, you can get a 5% return. Well, if you can put it there safely today, when it was zero just 2 years ago, what did your return effectively look like after taxes? Zero. You're going to make different choices about where you allocate your capital, right? So a VC, we don't do that, but our investors have that option and that choice. Okay. Any questions about this first part of the presentation? No? Okay. So just a couple of other quick things that I'll mention our class year internship program. We think of it as a secret weapon. It's something where we've had literally over 100 graduates through the program. They are out working in all these companies and they're scouts for us even after they graduate from our program. They come from Tepper as well as a number of other programs here at CMU and other schools across the country. This literally is the whole group that have graduated through our program. What row are you in, Sarush? First row, there he is. There's a current student. There's a current student. There's a current student. Yeah, you can go and talk to all of them and find out a little bit more about it. And here's a little bit better pictures of the ones that are active now today. So we're currently recruiting for the program and welcome any of the master's level students that are in their first year of their programs. That's typically our criteria. And I'm happy to chat with you after this session about that. This is just a sample of some of the kinds of projects that our interns work on. And some of them are working directly with our portfolio companies, others with us, and on all sorts of different interesting topics, and super helpful to us and hopefully to our interns as well. And maybe one or two last slides, although I know we need to wrap up pretty quickly. So people ask me, and especially students, should I start a company right out of school or should I wait? The answer is, if you have the passion to be an entrepreneur and you have the right idea, you should start at any time that you feel that you have the ability to do that. But if you look at the success ratio, you also shouldn't be terrified that if you don't start one right now today, before you graduate, you aren't missing out. In terms of opportunities to actually have a really successful business, it turns out that it's a little bit later in life, after you might have been part of another startup, after you may have built a bigger network. And I think the network actually might be the most interesting element of this. This isn't our research. This is published in Harvard Business Review. It's a deep academic research that was done across thousands of startups, high scale startups, not, grocery stores and dry cleaners, et cetera. And we find it really interesting because we then went and took a look at our own portfolio and said, where have some of our best outcomes come from and where do we think they will come from in the future? And you can see some of our founders here and the kind of success stories that they have to share and their age when we first invested. We don't use age, gender, ethnicity, any of that as investing criteria, none of it. But it was really interesting to me after seeing that data to go and look at our own portfolio and do a little bit of an assessment. These are some phenomenal founders in our portfolio that have achieved amazing things. Chris Cabrera, first generation Latino founder, CEO, Neha Sempat, she and her also Indian husband co-founder have built a company that has scaled revenue 50-fold in just 5 years, doing incredible things. Jim Dye was the founder of a company that merged with Coupang and became the second largest IPO of the year in 2021. These are incredible founders. And Jim was the VP of engineering in the company I founded. So we've known each other a long time. And that is it. That's the presentation. If there's any additional questions, I'm happy to take them.